first thing that you need to understand is this. We said net profit method is used when an accounting profit or income is provided. So that's the first thing, that it is used when accounting, and put it in capital letter to emphasize on the same, when accounting net profit or income is provided. So when you see that you are given that accounting profit and then you want to get the taxable income, use this approach. The first, when I was doing the introduction, I told you the difference between an accounting and the taxable income. And we say accounting profit or income is the one determined by accountant as per accounting standards to be presented to the shareholders. Now, taxable profit or income is the one that need to be charged tax. You'll always find, in most cases, the accounting income and taxable income are two different amounts. That you may find an accounting income can be 100 million, but the taxable income is 150 million. First of all, we need to understand what make the two incomes different. What make the two incomes different? These are the items that make the accounting income and taxable income different. So we have differences between accounting and taxable incomes. So, number one, some expenses deducted in accounting cannot be deducted when getting taxable income. i.e., depreciation. Depreciation. 2, some expenses deducted in taxable incomes cannot be deducted when getting accounting income, i.e., capital allowances. Number 3, some incomes included in accounting incomes are not included in taxable incomes. These are the 3 major reasons why accounting income is different from the taxable income. And the reason why you may find the accounting income to be like 100 million, the taxable income is 150 million. That there are some expenses you deduct when you are getting the accounting income, but you cannot deduct them when you're getting the taxable income. And we have given an example, is depreciation. depreciation should be deducted when you're getting the accounting income to be reported to the shareholder. When you go to the taxation, the KRA will tell you, don't deduct that. That is not allowable. That was one of the major reasons. Another one is that some expenses deducted when getting the taxable income cannot be deducted when getting the accounting income. A good example is the capital allowance. Actually, capital allowance is used in taxation instead of depreciation, which is not allowable. And you find that depreciation might be a different figure from a capital allowance. So that is another reason. And the last one, you may find that some incomes used in taxation are not included when getting the taxable income. A good example of this is this: unrealized, i.e. unrealized foreign exchange gain. That you may find an accountant has included it when getting the accounting income, but when it comes to the taxation, the taxman will tell you, we don't tax incomes that are not realized, so you don't include it. That will make them different. So, when a given accounting income, how do you adjust it to get the taxable income? This is how we do it. The formality on the first part remain the same as the gross profit. First, indicate the name of the business. In this case, I call my business again ABC. So, ABC business. What you want to get is the taxable income, and then taxable income statement for the period ended 31st of December 20 there, depending on the year. So what you do, as we said, you will be given an accounting income. It is the one that you want to adjust to get the taxable income. Start with it. I'll start with accounting income. It can be a profit provided. Come and post it here. Like in my case, I said an accounting income can be 100 million. Come and post it here. You do two adjustments to get the taxable income. First one, you add. You normally add two items. One, non-allowable expenses in P&L and taxable operating income, not in P&L. Allow me to change this to understand better. Omitted in the P&L. Now, what do we mean by this? Understand this. We are starting with an accounting profit or income. Profit determined by accountants. When accountants are determining profits, what do they normally do? If you remember a bit of financial accounting and financial reporting, you are told to prepare profit and loss account. And in the profit and loss account, you used to take incomes of the business minus expenses of the business to get an accounting profit. And that is the profit that we are having here. So when you talk of P&L, that is profit and loss account. So what we mean is this. When accountant was determining this accounting profit or income, there are some expenses he or she deducted in that profit and loss account, but are not allowable, cannot be deducted. I gave an example. Depreciation. Accountant deduct depreciation, but in taxation it's not supposed to be deducted. So If the accountant had deducted depreciation and now in taxation is not supposed to be deducted, you need to add it back. So I'll start with that. Non-allowable expense in P&L. Depreciation in P&L. It must be in P&L. It must have been deducted. If accountant had not deducted, you cannot add it back because it could not have reduced the net profit. So you only add if it had been deducted in P&L. Another good example that, of an expense which accountant may deduct, but when it comes to the taxation you are not supposed to deduct, is the cost of fixed assets in P&L. A good example is furniture. Sometimes accountants, instead of accounting for depreciation of a furniture, may decide to deduct the whole cost of the furniture to get his or her net accounting profit. In taxation, we don't allow cost of fixed assets. So if it had been deducted, add it back here. One more expense which an accountant may deduct but which is not allowed to be deducted in taxation is impairment. Impairment is usually for intangible assets, and it is usually almost the same as depreciation. And just as we said we don't allow depreciation, impairment is also not allowed. So if it had been deducted in P&L, add it back. For now, those are the non-allowable expenses that you might find in the P&L which are not allowable, so you add back. One more item that you normally add back is the taxable operating income omitted in the P&L. What that means is there is an income an accountant was supposed to add here. It is taxable, but he or she didn't include it. A good example we said is the discount received. You may find by any chance, maybe the accountant forgot about that discount received, so didn't include it when he was getting his accounting income. So what do? As knowing that it is taxable and it's not here, we need to add it. So taxable operating income omitted in the P&L. Example, discount received. So we may put discount received not in P&L. So that must be not in the P&L, because if it is in the P&L, you cannot add it because it's already here, had already been added. If you added, that would be double addition. So it must be the one not in P&L. If you find any other taxable operating income, like realized foreign exchange gain, which accountant didn't add here, add it. These are the two items that we normally add. Then now we go to the second adjustment. We talk of lessing. So here we normally less. There are usually three items. We call them a non-taxable operating incomes in P&L, comma, all investment incomes in P&L, and the last one, allowable expenses omitted in P&L. So here we are. The items that you're supposed to less from an accounting profit provided. Remember, we are adjusting the accounting profit. We are saying first, non-taxable operating income in P&L. Meaning, an accountant could have included an income here in the accounting income provided, but in taxation that is not supposed to be taxed. What does that mean? If you're not supposed to be taxed something that is included here, we need to minus it, to deduct it. A good example, we said this. When it comes to the foreign exchange gain, Realized foreign exchange gain is taxable, no problem. Unrealized foreign exchange gain is not taxable. So, if you are told an accountant had included unrealized foreign exchange gain here, then it is not taxable, you need to deduct it then. So, you come here and say unrealized foreign exchange gain in P&L. It must be in P&L. He or she must have included it here. If he or she had not included, don't deduct because it's not there. So it must be in P&L. You come and post it here. You deduct it. Although we said we are going to look at a list of non-taxable, but another non-taxable income you may find is the profit on disposal of fixed assets. If it's in the P&L, deduct. So, if an accountant had included profit from disposing a fixed asset here, that is not taxable, we need to deduct. These are just two examples. Another item we have said you normally deduct is all investment incomes in P&L. So meaning an accountant had included an investment income here, which we are deducting. Why are we deducting? Now, you'd have noted when we were finishing our statement, when we are getting the taxable income, we are finishing with operating. Operating. Why? Because in taxation, income from different sources must be looked at separately. If it is an investment income, it will be looked at separately from operating incomes. So, if you want to look at them separately, and the accountant tell you that he had included an investment income here, deduct it first, so that you remain with operating income. Then you can look at that investment income separately. So, if you are told like there was an investment income like dividend and rent income included here in P&L, deduct them. So, we have dividends and rental incomes in P&L. It must have, all they must have been included here for you to deduct them so that you remain with operating income. The last item that we have said we are supposed to deduct is allowable expenses omitted in P&L. Meaning this, when accountant was determining this accounting income, there is an expense he or she was supposed to deduct, didn't deduct. So meaning this accounting profit is overstated because an expense was supposed to be deducted, not deducted. A good example is, we said electricity expense is an allowable expense. A business electricity expense is an allowable expense. So if you are told of the profit the accountant has provided, he or she forgot to deduct business electricity expense of, let's say, 2 million. What does that mean? It was supposed to be deducted. It is allowable. It has not been deducted. So it is time to deduct. So we can give an example. Electricity expense not in P&L. Come and deduct it there. That is one. There is another one that is very common. Actually, you will not find it being deducted by accountant because we said accountant do not know about it. Accountant know about depreciation, which we say depreciation is not allowable. We added back. Accountant could have deducted the cost of fixed assets. We said in taxation, cost of fixed asset is not allowable. Now, what we allow instead of depreciation and the cost of fixed asset is the capital allowance. So, come and deduct because accountant will not have deducted. So, capital allowance not in P&L. It's usually not in P&L. It's usually not deducted by accountant. These are just examples. If you have any other allowable expense not deducted, deduct. After that, what do you do? Take the accounting profit provided, add these items you have said you are supposed to add, minus these items that we have said you are supposed to minus. The difference would give you the net taxable operating incomes. So come and post it there. And there you are. You can go ahead and now tax that particular income.